Jeffrey?
Yes.
All right, we are at noon. If you want to get started, we have 8 people on the call.
Okay. Go ahead and begin.
Yes, the floor is yours whenever you want to get started.
Thank you, Chanel. Thank you for everybody on the phone and also participating in the webinar. Thank you for the honor and the privilege to present to you today. By way of background, I'm currently the managing director of the Midwest for Square One. Square One is one of the largest venture banks in the United States. All we do is exclusively focus on both the venture funds that bank and back startups as well as the startups themselves. So what's unique about us is that the majority, ironically, of our portfolio companies, which we have over 2,000 clients on a national level, are ironically losing money. And what is unique is that those are all companies that are losing money by design. That is to grow rapidly, to grab market share, and to pursue a market thesis where they believe that they can make their customers better at what it is they do, as well as a good rate of return for their shareholders and other stakeholders of their businesses. My prior background to this, I spent about 15 years in 2 different venture capital funds, all in the Midwest, investing in a range of technology-oriented businesses ranging from traditional software companies to ag tech to healthcare. So have seen and kind of run the gamut of opportunities, not just finding the deals, but doing them, i.e. investing and sitting on the boards and then eventually taking them to their logical terminal point, whether that be mergers and acquisitions, an IPO, or in some cases, Chapter 7 or 11. So not all startups end as hoped for. And prior to that, I was a merchant banker for a group in the Midwest as well. So kind of turning the page here, what I really want to talk about today is helping sort of paint a path and paint a picture of should you have a highly technical background and either in the capacity of an undergraduate student or a veteran alumni, if you will, to sort of illuminate what the possibilities are as it relates to entrepreneurship. So just turning the page here, this is sort of the big backdrop. These are sort of the big buckets that you need to be mindful of. And in this idea evolution category, this is sort of the ideation mode where sometimes you're just walking down the street and you've got an idea about, wow, this could be significantly better if we did this. Or maybe you're with a group of colleagues at your current company and you are contemplating a new modality, a new technique, a new hardware or software that could be pretty profoundly disruptive. Well, what I would tell you in those moments, in those circumstances, don't waste a minute in time. Write it down and try to memorialize that thought and that idea. And what I would challenge you to understand is that in the realm of startups and venture capital, that more often than not, in order to really stand up and kind of constitute a new enterprise that's going to pursue a certain value proposition, you really have to look at a 3x multiple of an ROI to a customer, return on investment, meaning if they're doing something today, it's the way they've always done it, in order for them to actually stop what they're doing and do it the way that you're suggesting they do it, either vis-a-vis a software product or a hardware product or a new service of some sort, then it's got to have a really compelling return on investment to them. Not just the dollars that they put forward to purchase it, but also the ability to then use it and significantly save either time or energy or money from using your product or your idea. And so then the next part of this would be to start to spool up the semblances of a business plan so that you can do what I call a double click on some bigger areas or ideas that you have about this endeavor. One of them is going to be, what is that product or service? What is this total addressable market? Sometimes some markets are not as big as you might think that they are. So if it's a market that might be $50 million, that's a difficult market for any investor, either angel or friends and family, or even venture investor to get their arms around. Most, and this presentation, I should say, is going to be more oriented towards looking at a funding pathway that could originate with yourself in terms of self-financing it, to friends and family, to then stepping it up to angel investors, and then actual institutional venture funds. And when you get to the end of that spectrum, or that continuum, they are going to be looking for large total addressable markets, in many cases billion-dollar ideas or billion-dollar opportunities. So you'll want to get your arms around if there's a there in a particular market. You'll then want to understand the unit economics of such a model, and then what team it's going to take for you to prosecute a particular strategy. And then lastly, what kind of financing plan you're going to need to put together in order to make this idea a reality. When it comes to your product itself, there's a lot of lingo out there. One of the ones that's more commonly had is something called an MVP, a minimally viable product. And that's something you're going to want to use out in the marketplace to test, and then go back and refresh, test, refresh, such that if you can get some decent uptake off your first sort of version 1.0, you've got something there then. And it only can get better if you go to a 2.0 and a 3.0. So try to get something out in the market sooner than later and see what type of receptivity, whether positive or negative, you can gain from that. For your team, I always advocate finding SMEs, subject matter experts in their own particular right. That could be not only by technology, but by kind of functional area of the enterprise, that whether it's sales and marketing or operations or what have you, and I'll touch on that later on. Capital, I've already discussed. There's a continuum that exists, starting with one's own credit cards and savings, and then moving onward and upward to an array of sources, not just in your community, but onward on a national scale, and we'll hit on that in a little bit. And then lastly, you have to be ever so mindful of the fact that if you do take other people's money for this endeavor, that at some point you will need to provide a rate of return at some point down the road. In the case of venture capital funds, oftentimes they are seeking returns well in excess of 30% on their money in terms of an internal rate of return. That's an annualized rate. And what that translates into over a 5-year horizon is about 5 times their money. So it's a significant rate of return that you're going to need to have a line of sight to in order to attract certain types of dollars and certain types of monies. But the reality is that this can be you. And in this slide, you'll see that for a number of folks, whether they be students or professors for that matter, there are a tremendous number of technologies and companies that have blossomed out of a university setting. And in this slide here, in this pictorial, there have been over 400 over the last number of decades. And many of those have attained an exit valuation where they have made a meaningful rate of return for their investors. So just know that no idea is a bad idea, and that whether it's just literally a very, very early stage technology in a university lab, for instance, or in a corporate setting, or even in your own garage, is that it can be a success, and it can make an array of stakeholders money. Next slide. What I've done here, and for those of you that are following along in the webinar, you can double click on the top right. But what's interesting that slide is going to actually showcase to you an array of resources in a more of a physical kind of format where you can incubate your idea to really test some of the things that I mentioned in the prior slide about the MVP, about the total addressable market. What we have here in the Midwest is, while a small venture market overall, one dominated by both California, Massachusetts, New York, and other areas, what we do have is two things. One is a very rapidly growing market, and two, a number of kind of pillars, and I can speak for the Chicago community with certainty and conviction, that I think are very, very compelling and unique. For instance, there is a technology incubator, an accelerator called 1871 that's in the Merchandise Mart that's focused on software, B2B, B2C, and other areas, including veteran-owned businesses. So they have really been a linchpin in serving as a catalyst to get other types of accelerators off the ground. Another one is called Matter. Matter is exclusive to healthcare. Steve Collins, who helped start 1871, then pivoted to start Matter, and what a unique setup he has there in terms of major health systems as partners, labs, a number of prospective customers, EIRs, entrepreneurs and residents, to help businesses get to that next demonstrable inflection point. And there's others. Catapult is another. M-Hub, if you're a maker, you'd like to tinker in a manufacturing type setting, M-Hub is a great opportunity. Lightbox, Sandbox, I can go on and on and on. But if you click, for those that are on the phone from Chicago, you can start to see the roster of resources that are available to you, notwithstanding IIT and the University Technology Park as well.
Do you think, Jeff?
I'm sorry? Moving on, as I had alluded to, the Midwest, while not a major hotspot of investment dollars, it's still pretty consequential. There have been over $3.7 billion of deals done in our broader geography in 2015. That's almost 750 companies that have been backed. So what you can see from this graphic is that it covers in different areas, but software is the dominant one. And for those on the phone, the reason why software is so heavily invested in is because, one, it is one of the easier types of businesses to start, and two, it scales rapidly. Whereas other ones, for instance, in healthcare and medical devices, you have a very long regulatory pathway and clinical pathway. That can take 5, 7, 10 years or more in many circumstances, and not everyone is able to fund that type of business for that kind of duration. And you need a lot of resources to bring to bear in those environments. But software, if you have an idea, it has a very good prospect for getting financed. For those of you, again, with a technical background, what you need to understand is that you're going to be facing challenges at every stage. They're not insurmountable. They're the basics of starting a company and then scaling it. If I could tell you on this list that I have here, one of the more important ones, in my opinion, in my experience, is the second one under the first bullet point, recruitment. There are many studies available that show that if you hire the wrong employee, especially an executive, it can cost you 10 times that person's compensation. And you're asking yourself how or why. Well, the reason is that number one, lack of productivity. Number two, lost time to actually get your product to market or actually further scale it. Number three, just general disruption in terms of having to work through or work around. You've had a straight line, you've got one circuitous. And then number three, any type of severance kind of pay. So you add all that up, and it's huge in terms of its detrimental impact to an enterprise. But if you make the right hire, goodness gracious, it can be an absolutely great thing to see. As you look at your stakeholders, investors, customers, employees, and service providers, what I would encourage you to do is as follows. Number one, over-communicate. Don't keep folks in a closet because they can't help you if you don't communicate in terms of where you are experiencing pain or actually where you're experiencing success, and they can further help you. Number two, from a style perspective, be confident but yet be humble with all of those groups. And three, it may sound obvious, but always tell the truth. It is hard when you have the ever highest of the highs and the deepest of the lows to be at a certain point in time in a tough state of mind. But just be straightforward and transparent, and it'll go a long way. Which is part and parcel to the next one, which is time frames. Most startups take on average about 5 years to become a reality. You usually spend about a year, maybe 2, doing the things that I articulated in the beginning. Starting to ideate, writing that business plan, getting that initial semblances of capital in the door, getting a few of the resources from a human capital perspective to help you, and then eventually launching that MVP, that minimally viable product. And then from there, if things are positive, you could really scale and have a nice run. And then as a business is actually having great success, you control your destiny more as to when you might want to exit out of that particular company. But the bottom line is that in the short term, it requires capital and grit. And in the long term, it requires tremendous endurance. And that's one of the reasons why many VCs set aside large option grants to their employees and to the executives that lead their businesses. And the reason being is that you don't want someone to labor for years and not be able to walk away with a 7-figure payday. And all of that opportunity cost that was given away, you don't want them to not be able to see that dream and that pot at the end of the rainbow of gold to attain. And that includes not just the executives, but like I said, all the way down the roster of employees. There's no one that should not be important in that enterprise. And they should be granted an opportunity to realize the overall dream of a particular business. The next slide, you're always going to be fundraising. It's very few and far between that you can find a business that has self-financed all the way through the matriculation of its life cycle. So what I have here is just a little flavor for the types of capital depending on where you are. Most businesses are going to be financed with some sort of equity dollars initially. And the reason why is because in the absence, in the instances of like what I do, where there are only institutional investors in the deals that we invest in, you're going to need more flexible, permanent capital to buy you time to get to a good inflection point, but then also cover those operating losses that are accruing over a period. And you'll eventually then go onward and upward to have folks that can write a larger check to be able to get you to that next point. What I would also tell you here is that if you do have a very, very strong technical background, but not so much on the financial side, not so much perhaps on the investor relations, not so much on the, what I would say in totality would be like a CEO, then what I would tell you is hire one. And whether you can or can't hire one full time, perhaps you can have a surrogate through a board member, through an advisor, or just a trusted friend that is part of this endeavor and tethered to it and will have shared success in the outcome, but that has more experience in dealing with these types of parties because it's a different beast. And what they're going to want to hear are the following 3 issues. Number one, a very, very concise communication of what the action plan is to take this business from 0 to something of consequence. Number two, you'll need to be able to clearly communicate, but your CEO would as well, a command of the technology and why the market that you are pursuing is in need of that solution, of that technology. And the last one, and this is a combo deal of the CEO, and if, for instance, if you're a co-founder CTO, is an unwavering level of passion and conviction that this idea can work, not to the degree where you lack objectivity, but to the degree that you actually have an experience set saying that here's the way it's historically been done, here's why we can save folks a lot of money, the data is crystal clear that that's a possibility, excuse me, a probability, not a possibility, and that I'm committed to the excellence that's required to make this business go from 0 to, say, 50 million in revenues. And also for this audience, as you consider adding value as a founder, as a technical founder especially, I think it goes without saying in the first box here, under the technical attributes, where you can actually really be impactful, is to help a business create a real enduring competitive advantage. There's a misspelling there, my apologies, it says completive, it should say competitive advantage, in a particular marketplace. And you can do that either through filing a patent. Good thing about a patent is that it grants you, in many cases, a 17-year window to have a monopoly on a market. The bad thing about a patent is that it's in the public domain, and moreover, once it expires, it's free game for all. So every year that goes by where you're not able to monetize that technology in a meaningful way, your competitive advantage actually is fleeting. If the IP, and specifically a patent, is one of the key differentiators about your particular product or service. The other way I would think about it also is trade secrets are incredibly powerful. You don't have to necessarily disclose these all in the public domain, or any of them for that matter. But if you have a technical background, you are uniquely qualified to be able to help a business in a way where maybe even a CEO doesn't have the technical chops to get really down into either source code, or in the case of a medical device, some of the idiosyncrasies of why that device is superior to anything else on the market to add value. So I'm a big believer in a book called StrengthsFinder, and to always play to your strengths. And if you do have a technical background, and one of the reasons you went to IIT is because you wanted to pursue an engineering degree or what have you, or science degree, leverage that strength and leverage that expertise to be as impactful as you can, because to try to mask weakness doesn't really do you any well. To amplify a strength can be very disruptive in a good way for a particular business. And what I'd also tell you to leverage that technical background is to look at the execution block here. And that is an area where knowing one's enterprise, knowing the specifics, the ins and outs, the technology, knowing what needs to happen to make all those trains run on time, priceless. Absolutely priceless. Knowing when to sweat a detail and when not to, that is a gift. And if you're able to leverage that gift that you might have, that is another way I think you can really be impactful again to a business that you can start. Of course, you've got the investors and the human capital side I've already talked about, but the two I think that are most germane to this dialogue and this audience today is under the technical and on the execution side. So let's talk about why so many startups fail. Interesting. You can ask many folks that same question and get a bunch of different answers. I have tried to reflect on this question for some of the deals that I've worked on that just didn't work out. And that's been a couple dozen companies that I've been a part of that have either just been wild successes, 6, 7 times our money, and others that just didn't work. And after reflecting on it for quite some time, I have the following 6 that are up here. Lack of leadership and strategic acumen. If you have the wrong people with the wrong skills running the wrong kind of company, you're going to have failure. That's pretty obvious. But it's more common than what you might think. And also, we always have to be aware of halo effects. Lightning doesn't strike twice in many cases. And so just because you had success one time doesn't mean it's necessarily going to happen again. It may mean that you know a lot, but you have to make sure there's a match of the skill sets for that particular success onward to your particular endeavor. 2, the right product but the wrong time. I would tell you this is probably one of the most prevalent ones with all startups. The issue that we have in starting companies these days is that while technology obsolescence cycles are amazing, if you look at a cell phone, for instance, you're talking 12 to 18 months in many circumstances. But in many other markets, there is a profound resistance to change. And while you may have the best widget, if the value chain, and that value chain defined as potentially your sales folks, the channels in which you're actually going to use certain suppliers, or excuse me, certain vendors to push your product, or even the end state customers, are just not going to be receptive to using your product. Why? Because you may be disintermediating some employees, or this is the way it's always been done in our market, and we're never going to change. And it may disgust many of us to say, why? Why would you do that when there's absolutely a better way? Well, it's very common in healthcare. We see it more often than not. There's tremendous waste in healthcare. And even in manufacturing, tremendous waste. And there's modality things, but for whatever reason, if you can't get an array of stakeholders in a value chain to buy into it, we'll never get uptake. And then sometimes you got the right time, the wrong product. It's just a mismatch. You design something, or a company designed something to do X, when the reality is the market kind of changed a little bit, and you really need to be doing Y. So you got to re-engineer it if you have time and if you have the capital. 4th bullet point, undercapitalization. I'm not going to go in there. That's an obvious one. The 5th, the erosion of competitive advantage. As I illuminated in the prior slide, if you take too much time to get a patent moving and monetized, you will erode your competitive advantage. And then the last one, which is very, very difficult to immunize against, but that they do happen, look no further than the financial crisis of 2008, less than 10 years ago. Venerable firms like Lehman Brothers, Bear Stearns, and many others literally vanished within months' time. It happens. Sometimes with specific companies, it could be a product recall that's just doomsday. So I have a saying, you don't want to major in the minors, but at the same time, you do want to sweat some details. So always double click on things if you can, if you think it's of consequence and importance where it potentially presents a binary risk for your enterprise. So if there's ever a spare time or a spare moment where you want your mind to kind of drift a little bit off X and go to Y, think about where those areas could be, where your enterprise could be vulnerable, where your startup, if you're trying to think about how to get something off the ground. And lastly, talk to as many people as possible about how they overcame particular risks, and use the resources at your disposal to tap into those networks to continue to seek answers as to why and how. And last kind of takeaway here is just be a good listener. I always try to listen more than I speak, which on this phone call, it's a monologue, not a dialogue. But the reality is I really try to understand with all the startups that we touch, how they're achieving what they're achieving and how they're doing what they're doing. So just really be a good listener. I can give you a couple of case studies, which I think you might find interesting. And this is the last slide, so I don't bore you anymore here, where the best technology does win and then does not win. I was part of a company, proud to say, that we took from a startup to well over 100 million in revenues and very, very profitable. It had a portfolio of patents that were to die for. It was truly remarkable. These folks patented everything they could, not just domestically, but internationally. It was expensive to do, very, very costly in terms of time as well, but proved to be one of the key competitive advantages of this business. The timing for this company was also very helpful. We were at a point in the market where customers and consumers were very desirous of where and what this company was able to provide in terms of an ROI. And it was, when I talk about the 3X, it was well over 3X. It was basically creating a floor of safety, a barrier of safety for a set of products, and create a binary situation where you could take one path, which isn't necessarily safe. We wouldn't recommend doing that, but if you have to, we understand, or use our product. What they also did was to be offensive. And what I mean by that is that they relentlessly protected their intellectual property. So anyone that came about that we thought were infringing on that IP, they immediately spooled up counsel to let them know, you got to stand down. We also had to take a major competitor to court. A multi-year battle, a multi-million-dollar battle for that matter. But ultimately what it yielded was a company that knew that it had to continue to innovate. And so the lesson learned as they built their business was that the clock is ticking. We're losing time on this intellectual property. We have to continue to innovate. And they relentlessly filed more patents. They actually created new traits, new ways of delivering their product and service, new modalities, and continued to have a value proposition that when they were desirous of selling, that could go into the next 10 to 20 years, they still have the same protections they had before then. So a great outcome for not just the investors, but for the stakeholders, for all stakeholders, the employees included. But on the healthcare side, this is one that didn't go so great. And you can see at the bottom here, I've got no plan survives contact with the enemy. That is an absolute truth. I have yet to ever see a business plan or financial model in my career that has ever been accurate. Why? Because by definition, it's a model, it's a projection. So while we're trying to kind of steer close to those things, sometimes they are so profoundly off, it's surprising. And here's a for instance. We had a company that by far had one of the most novel technologies to ever be launched in this market ever. And amazingly, it also had a portfolio of patents, top to bottom. They did not, they opened a door and closed every door behind them to make sure that no one could replicate what it was they were doing. But the issue was that they had an incredibly long sales cycle. And amidst that period of time, while they were out building this business, they had a change in federal regulations, which dramatically changed their market and the need for their product. And what's amazing is that today, while the business is still operational and still, I would say, chugging along, the status quo in a market prevailed. And the irony is that their solution was beyond 3X. It was 10 to 20X better than anything on the market. But here they are in a situation where the company is continuing the good fight, but it's taking twice as long. Actually, it's taken more than twice as long, and more than twice as much, more capital than what anybody can anticipate. So again, no plan survives contact with the enemy. So prepare, use all the resources available at your disposal that I've hopefully done a decent job illuminating here on this call today. And I will stop there and open it up for questions.
Jeffrey, can you hear me?
I can.
Hi, my name's Norman Papoose, class of '96 at IIT. Your very last words really resonated, and that is that no plan survives first contact with the enemy. We are, and I'd like to ask how you would respond to this question. We are in our third year, and we continuously are asked for a business plan, and nobody is doing what we're doing. So when we do a business plan, there's a lot of supposition we have to put in, and then undoubtedly we get contradictory advice back. VC firm A says too many revenue streams. VC firm B says too few revenue streams. You're asking for too much money. You're asking for too little money, and because we have no template to base a business model on, because what we're doing doesn't exist even remotely, we're constantly we stopped creating business plans, because that's all our time was going to that. So when people, come up to me and they sense a weakness, and that weakness is based on a guesstimate, because I have no data to base it on, how do you reply?
So I'm going to reply a couple different ways. One will be, there's an irony to fundraising that I've observed over the years. If you are walking into a room of prospective investors, and I don't care if they're angels or if they're institutional venture funds of managing $1 billion, if you are having to go above and beyond to prove to them that there's value here, you're in front of the wrong audience. The irony is that you have to match the investors' desires and knowledge and where they want to take a particular enterprise with your technology, your team, and your idea. And that is one of those contact sports discussions that's a different dialogue, but it's creating a sense of equilibrium in a room and with investors and stakeholders where they say, I got it. And you're almost convincing them. Okay, do you have all the, do you know everything you need to know here? Because this is how long of a haul this is going to be. There's a lot of unknowns. And you find and observe a behavior where, they're convincing you this is the best thing to ever do. So clearly it's supposition here for me in that I don't know how many investors you have spoken to, but what I would say is that there are more to be had to try to find that precise match, because I agree it is profoundly discouraging to be told no, to be criticized, to say, well, too many revenue streams, not enough data. But what that's also telling you is that you have a set of investors in front of you that are risk averse. They are risk averse for the kind of business that you're trying to build, Norman. And I would tell you that it's going to take a longer time, I hate to say that, to find the right investor that is going to be desirous of backing you. My second answer to your question is that it would never discourage me to memorializing a business plan, because what I always find interesting is to go back and look at my notes from prior years and reflect upon what the best relevant information I had in that particular point in time was, and then 1 year later how it's changed, which will be reflective of the macro market, the micro market, and then my company specifically. And that I always kind of try to sort of take those granular sort of lessons learned out of that and say, goodness gracious, it did change that fast, or maybe it didn't change that fast, or here we go again. So I would never discourage someone from putting that plan together with best available information at any point in time, because it's the best you can do.
Well, thanks for your reply. I'll be reaching out in the next 24 hours, if that's okay.
Sure.
Okay. So if we don't have more questions, I'm going to thank Jeffrey for his time on behalf of the Alumni Association at Illinois Tech. I will be sending a email with this presentation in the near future. We will have another Hawk Talk in November. We'll also send a communication to let you all know exactly when that will take place. Otherwise, thank you all for calling as well, and I will hear from you all in the future.
Thank you. Thank you very much for your insight, Jeffrey.
Welcome. Thank you so much for having me.
Yeah, thank you. It was very interesting.
Thank you.
Thank you. Thank you for having me.
Are we able to send emails to Jeffrey later on?
Say that one more time, please.
Are we able to send email questions to Jeffrey later on?
Jeffrey, do you welcome questions in the future?
Sure, via email. I can certainly field them. Chanel, you have my email address if you want to circulate it to certain parties on this call.
Okay, and you can, so my name is Chanel Hampton. I work with the Alumni Association. You could send me an email directly at champto3 at iit.edu, or you can email the alumni inbox, and I'll make sure I get those questions to Jeffrey.
Sounds good. Thanks, Jeffrey.
Thank you. Good day, all.